Thank you very much. Good afternoon, everyone. Um, I hope you can see me and hear me clearly. Also hope you've had a nice lunch break. I must start by apologizing for the earlier time zone confusion between the UK and New Zealand. It's about half an hour past midnight here. Also, thanks to Professor Bife for taking over in what was my original slot. Right, so I'm very pleased to be able to provide this talk about the nexus between artificial intelligence and finance. This has been quite a passionate research topic for me over the past few years. Probably would be useful to agree on a definition for artificial intelligence and then start from there. I must say that, as I'm sure you know, AI is notoriously difficult to define because intelligence in itself is notoriously difficult to define. Human intelligence is difficult to map out, and by extension and by implication, artificial intelligence is similarly difficult and intangible. But what probably quite an easy shortcut would be to say that developing and theorizing about systems that are able to perform tasks that have traditionally required human intelligence could be seen as artificial intelligence. So we're talking about cognitive functions which are associated with human mind. Some people go as far as talking about emotions that are associated with humans as well. So I think the crux of the matter is, where would you draw the boundary? Because we are not perfectly rational in a normative sense. So is artificial intelligence aspiring to what human intelligence is with all its strengths and weaknesses, or is it aspiring to a cleaner, more subtle form of intelligence, which would be human intelligence, but then devoid of its weaknesses? So in some sense, AI is augmented intelligence as well. So plenty of definitions out there, but I think we all have a sense of what we're potentially talking about here. Now, historically, the US has been a hotbed for AI innovations. If you look at the number of patents published on AI technologies, historically, US has had the most, followed by China and other countries in both Asia and, of course, Europe. But if you dig deeper and look at the more recent years, you will notice that, in fact, it is China which has kind of taken over in terms of the volume of innovation. If you look at the number of published patents again, in the past 2 decades, China overtook the US around the year 2013. And while this is a crude measure and in no way a perfect measure, it kind of goes to show that indeed there has been a very, very tense battle between the US and China in the first instance in terms of producing AI innovations. And this also translates to the applications of AI in the finance world, which I'll come to. So speaking of finance, AI, you could argue, has had quite a long history in finance. Some financial experts like to think that indeed some of the financial innovations have been lending themselves to artificial intelligence innovations. So there's been quite a symbiotic relationship. There have been quite a few hedge funds which have been at the forefront of AI innovation in the past few decades. You can see examples of them here. Renaissance, a big name in this space, still going strong. D.E. Shaw, Man Group, which is quite well known here in the UK. Banks as well, banks such as UBS and various others have been quite instrumental in both designing and deploying AI technologies when it comes to financial applications. So there's been, you could argue there's been a lot of demand from the finance sector for better computational power and better intelligence, but in some sense also a supply of talent into the tech sector. So that's why I call it symbiotic relationship. Now, what makes AI important for finance? I think that's a very important question. And you can answer it in a number of ways. So why should the finance industry and the financial services sector care about artificial intelligence? Right. So on the one hand, in finance, we're dealing with very large, high-frequency data sets. If you look at stock market databases, we're dealing with thousands and millions and potentially hundreds of millions of transactions every day. And not just transactions, so we're not talking about just stock prices. We're dealing with all sorts of information related to companies, including, of course, market data, but also fundamental data. And we have plenty of news hitting the market every second, which affects the stock prices. So there's plenty of data out there which needs to be digested. And then, of course, there's need for speed because financial transactions happen in a fraction of a second. Clearing is getting faster and faster as time goes on. And so speed really matters. Speed in this case literally translates to money and returns. And because of the huge complexity in financial transactions and financial data, the finance industry has a strong need for pattern recognition. Again, dealing with stock prices, of course, it's everybody's wish to predict where the market is going tomorrow. How is it opening? How is the FTSE, for example? Or how is the S&P 500 opening up tomorrow? And well, if you believe in market efficiency, you would argue that the current state of the market, the current share price, is the best forecast for tomorrow's share price. But of course, we know from finance theory and from decades of behavioral finance research that markets are far from efficient. And there are all sorts of frictions in markets. There are human emotions involved, and therefore there is a place for pattern recognition. Lastly, but equally importantly, you could argue that the finance theory itself is relatively immature. It is relatively young. It's only a few decades old if you compare it to its older brother, which is economics. Financial economics or finance is relatively young, and there are still plenty of open questions. The theories which were considered mainstream and undebatable in the finance literature, some of them were brought to question during the financial crisis of 2008, and the limitations of some of those theories was shown quite clearly. So it is still evolving. It is still relatively immature, and for those reasons, again, it needs the help of it needs a helping hand, and I think AI could be very helpful in mapping out the limitations of those theories. So in some sense, you could argue that financial markets are volatile, uncertain, complex, ambiguous. They're VUCA, to use the acronym coined by James March. Many things are happening at once. There are problems, solutions. There's the human element, which I think overcomplicates things. So let me give you an example. You can do all sorts of financial analysis on a company like Tesla. Look at its balance sheet, look at its volume of production, um, throw every theory at it, and then try to predict where the share price is going to go tomorrow. And then Elon Musk will come on Twitter and tweet something, and then that could completely disrupt your analysis. So how can you account for something like that? There's plenty of unaccountable complexity out there. There's a lot of unknown unknowns. And again, in a situation like this, you do need artificial intelligence or superior forms of intelligence that limited cognitive intelligence cannot provide. So with that in mind, let me go through some of the applications of AI in finance. So clearly we have applications in trading. Of course, historically, financial transactions have been done manually by humans, but then we moved on to algorithmic trading, in which algorithms were supporting human traders. And then we've moved on to a higher level of automation where algorithms have begun to take over from humans. In many cases, they have taken over from humans. And so they provide both the decisions and execute the decisions. And some people argue the so-called flash crash of 2010, in which the Dow Jones dropped sharply during a 15-minute window, could have been due to losses triggered by computer traders, by automated traders, following each other into a crash. Because sometimes a slow brain is helpful when you see something going on. A slow human brain might pause to think, but then a very fast computer would have executed thousands of trades in a fraction of a second. So small errors could multiply. And that has led on to high frequency trading in more recent years, as we know. So higher and higher levels of automation are being achieved by financial traders. And I think this is an area which is, of course, seeing plenty of progress. The question is, what is the ideal to aspire to? Is it no human intervention? So do we want computers to make all sorts of trade decisions and run them without absolutely any human intervention? And my sense is that that would not be the ideal situation. So you do need human interference. So you don't want to get to level 10. You want to end up somewhere in the middle. And I'll come to that later. There are plenty of applications in investing. This interesting graph from Barclays research shows 40 years of data. What would have happened if you had invested in a global basket of stocks, in this case, the MSCI World, in a given year, and if you had held it on for a number of years and sold it. So for example, this is from 1970 to 2010. So the example here is, what would have happened if you had bought this basket of stocks, which is diversified, in 1975 and then held it for 20 years and then sold it in 1995. So the greener the color, the higher the return on a real-time basis. So in other words, what this shows is that long-term investing typically does not lose you money. Based on historical data, the longer your investment horizon, the better. Of course, you can make significant short-term gains by playing a short-term game, but also it's hugely risky because you can get caught up in these red areas, which are all the famous crashes we know, including, for example, the dot-com crash of 2000, the global financial crisis of 2008, and so on and so forth. So long-term investing seems to be a relatively safe alternative to short-term investing. Therefore, if you're an investment company and you want to earn fees by managing investors' money, you have to provide an added value. And that added value could be indeed realized by using artificial intelligence. And I think AI is particularly becoming a handy addition to investment companies in this respect. So helping them mitigate the red bits, so to speak, and providing an alternative to very cheap forms of investing in the long term, which is provided by index funds. And plenty of investors are benefiting from them. There are other applications of AI in finance, including identification, so multi-factor identification when you try to enter a banking portal, for example. Chatbots. Not all bots are intelligent, but some could be, and the more intelligent the bot, the better the customer experience. And I suppose the more money a financial institution would save by mitigating human interaction. And of course, but with all the costs that comes with. Robo-advisors clearly are growing their market share, and they're competing with traditional human advisors when it comes to financial advice. So that is a very dynamic battlefront again to watch. Credit scoring is again a significant application of computer intelligence and AI in finance. Basically, the typical platforms for credit scoring have significant delays. So what you really see in your credit score may not reflect the most up-to-date information. And they also draw on a limited number of data items, let's say from your banking history. But AI could draw on a much larger set of data points about you and your financial behavior or your behavioral fingerprint, so to speak. And that can lead to far more accuracy at a much cheaper cost. Now, we can move on from the customer-facing front to the in-house financial applications. So clearly, fraud detection is a very much in-demand application of artificial intelligence in finance. When it comes to anti-money laundering, it is used significantly by banks and also by governments. A very interesting and important application of AI could be portfolio optimization. So let's say you're an individual investor and you want to optimize your portfolio at the asset level. So how much to invest in equity or stocks, how much to invest in bonds, etc. Or let's say you have a portfolio of stocks and you want to decide what is the best optimization outcome, how many stocks should I hold, and so on, and what should be the weights and so on. So again, this might sound like a simple choice problem, but it's actually quite difficult to optimize because all of those stocks come with non-normal distribution patterns in terms of their financial returns, and there are all sorts of cross correlations which are dynamically changing through time. So it's quite a wicked problem in some sense. Risk management, forecasting non-performing loans or NPL, again, a significant use case for artificial intelligence. stress testing, especially for financial institutions such as banks, could be very, very important. And this was significantly highlighted by the problems that banks faced during the financial crisis of 2008. And since then, of course, there has been far more emphasis on this. So you can see that the list of use cases for AI in finance goes on, and there's no question as to the importance that the finance sector considers for artificial intelligence. Let me give you one very specific example. If you're investing in companies, you're probably reading their annual reports, or you should be, in fact. But the problem is that these annual reports, which get published once a year, they tend to, they have grown significantly in size. So they've become longer and longer. And from about 10,000 words to something like 60,000 words in recent years. So they're long and they're not particularly readable. There's a lot of jargon in there. There's a lot of legalese. There's a lot of lawyers speaking there. There's a lot of weasel words. It's very difficult to get to the real meaning. And that's where sophisticated textual analysis softwares can work and can help. So for example, finance research has shown that low readability of annual reports can lead to volatility of share prices. And that's really interesting. So the more opaque the language, the more volatile the share price subsequently. So if we can measure that using sophisticated textual analysis in real time, that can be very telling for financial performance of the company. Now, of course, textual analysis has its limitations, but when it comes to spoken language or natural speech, for example, corporate conference calls, when the CEOs of companies discuss their earnings in conference calls with financial analysts, that's a spoken language, which lends itself to better analysis, in fact. And you've got plenty of financial speeches from central bankers, from investment bankers, from CEOs and CFOs. There's a lot of spoken word, there's a lot of natural language, which is easily transcribed and can be fed into intelligence programs. One example would have been in finance. It is quite well known that the former chairman of Federal Reserve, Alan Greenspan, was very good at obfuscating his speeches. So he was very good at providing opaque language, and computers can be coded to decipher his language, let alone more normal speech. So that's just one interesting example. Now, we're quite close to Christmas, so I was thinking it would be interesting for me to try to compile a list, which would be a wish list from a finance perspective for AI. So if the finance sector has a wish list for the community of AI developers, I think that includes 5 items. So one is compatible AI. So AI that is compatible with the existing infrastructures of a bank, for example, so that the bank doesn't have to completely revolutionize its digital infrastructure. Now, later today, as I was looking at your program, you're going to hear about how the financial services can partner or build AI. So that's a big question. Should you partner with the industry, with the AI industry, or should you just build your own applications from scratch, or should you just buy off-the-shelf products? And I suppose the ideal thing would be to provide customizable products that you can buy without having to develop them yourself. So that's item number 1 on the wish list. Item number 2, in my view, is robust AI. And what I mean by that is just like humans hit a wall and then they turn, you want your computer programs to be resilient to errors. So when they hit an error, they won't crash. Instead, they would find a way to go around that bug. And this code, which is effectively what I just said, comes from Marvin Minsky, who is one of the pioneers of artificial intelligence. So you don't want bugs to paralyze your computer program. You want the program to be resilient. So that's robustness, and we want to see robustness in AI, but specifically when it comes to financial applications, I think robustness is key, significantly key. Of course, you want AI to be ethical. We've all heard stories about facial recognition softwares which are potentially exposed to racial bias or gender bias. I'm sure you've heard of the lack of diversity in the AI community, the history of algorithmic bias, which has been coded into original AI algorithms in various ways. And of course, you want modern AI applications, especially for the finance sector, to be completely immune to these sorts of accusations. Speaking of which, the Center for Internet and Society at Harvard University has come up with this disk you can see here, which is I believe, a very comprehensive and excellent list of considerations when it comes to having an ethical or principled, in their language, artificial intelligence ecosystem. So this is, I know this is pretty dense on this slide, but I've just zoomed up here on part of this, and you can see some of the principles that this Harvard team tends to take into consideration include, for example, promotion of human values, professional responsibility, human control of technology, fairness, transparency, safety, and so on. So, so a principled AI ecosystem, of which ethical AI or fair AI would be a significant part, is extremely key. And of course, this is a debate that is going on in various circles, and there are all sorts of white papers and lists of principles that have been compiled in many circles. But still, there's probably little consensus on what is the level that you should aspire to when you're developing AI from scratch. So I think that could be an interesting compendium. Now, of course, AI needs to be explainable. This is, again, extremely important in the finance sector, among other sectors, because, for example, regulation in finance suggests that, or mandates that, if consumers are denied credit, so you apply for a loan and you're denied based on a black box AI application, you have to know why you've been turned down. And so there needs to be a list of specific reasons. So you can't just rely on a black box AI decision. There needs to be meaningful information about the logic of these decisions. And for those reasons, particularly in the finance sector and for financial applications, AI has to be explainable and it has to be interpretable. Now, of course, there are inherently interpretable AI approaches, which are particularly when it comes to machine learning, they are quite bread and butter. So you can of course rely on decision trees or inductive logic programming or rule mining and so on. But the problem is the black box. So when it comes to black box AI systems, they can lead to lack of trust, public trust in AI, and they can lead to some sort of AI phobia. And so that's the whole effort by the explainability community to try to make AI more explainable. And I know you have again on the program today later on, there is a talk which is supposed to focus on this very, very interesting point. And last but not least, AI needs to be responsible and accountable. So if your AI solution in a bank loses a customer, his or her fortune, he or she needs to know who to sue. Just as when now there is a very interesting article in this MIT Technology Review, which suggests that when algorithms mess up, it's the closest human agent which gets the blame. Of course, not the algorithm, although the algorithm itself is supposed to emulate humans, but they always escape the culpability. And that's really interesting. So to what extent do we, or should we, require algorithms or intelligent programs to be accountable? And I believe that when it comes to financial services, this is, again, a very, very, very key question that needs to be properly debated. So I cannot, of course, resist the temptation to bring in a chess metaphor here. Kasparov, the former chess champion, world chess champion, is famous for arguing for chess programs that would help human chess players rather than replace human chess players, because his argument is that indeed the best combination is for a powerful chess machine to complement an expert chess player, because their strengths and weaknesses complement each other. And I would argue, although the finance ecosystem is far more complicated than the 64 squares of a chess set, the metaphor would be applicable. So you do want very powerful AI, but not AI that would completely replace financial experts, but AI that would complement financial experts, because I cannot imagine AI completely replacing financial experts and then leading to sustainable, ethical, accountable outcomes in the ways that we described, and not lead to potential financial crashes, and that a slow brain would help mitigate. So I think that's, again, up for debate, but I think the chess metaphor would also apply to finance. So once again, this is my finance professor's wish list for AI, and with that, I would like to thank you for your attention, and very much look forward to hearing your views and listening to your questions. Thank you.
Thank you, Professor Eshraghi, to share your expert view on history and future prospects of the interaction between hedge funds and artificial intelligence. So I would like to open up Q&A. Is there any questions from the audience? Yeah, so I have some questions in this system. So the first one is, can you comment on the digital finance opportunities you see for New Zealand? So there are, right. Yeah, some digital finance opportunities. Yeah.
Yes. Well, thank you for that question. As you're aware, I live in Wales, which is kind of an island within the United Kingdom as well. Of course, I mean, it's not an island geographically speaking, but in many ways a distinct part of the United Kingdom in terms of language, culture, etc. And a country which is similar in size to, in terms of population, and in many ways to New Zealand, though not in size. Although I'm not an expert when it comes to the New Zealand finance ecosystem, I think there are similarities. So usually small size brings agility. And when it comes to deploying AI technologies. I think usually with a small size, you can afford to build from scratch. So if, for example, your banking system can afford to design AI solutions from scratch rather than rather than buy or partner, I think, my apologies, I think that could be very useful. And so I think with size, with relatively small size, comes agility. So you don't have to reboot the whole system. So that's one thing that comes to mind. I would again be willing to hear what the others think about the specifics of the wiki case, so the New Zealand ecosystem. But I should confess that I'm not an expert on the peculiarities of the finance ecosystem of New Zealand.
Yeah, thank you, Professor. So I would like to move to second question. Any experience or involvement with applying AI effectively where the organization has numerous isolated, disparate data sources?
So if I understood the question correctly, they're asking when the organization has very distributed sources of data, how would AI be useful?
Yes.
I think in a situation like this, actually AI is by definition a pertinent and relevant technology, because what we're dealing with here is disparate data, which would lead to ambiguity. By definition, it will lead to uncertainty, and you need learning, which again, human intelligence is often unable to cope with. So especially the larger the organization or the larger the ecosystem, the more true this is. So this is a typical use case for artificial intelligence, and we have many examples of this in various organizations.
Yeah. So, yeah, my last question. What do you see as the value-added area that AI can add in financial advisory sector? Yeah.
Right, okay. Well, that's a very good question. When it comes to financial advisory, there are two ways to deal with this. So you remember I mentioned in the lecture the role of robo-advisors. Now, traditionally, robo-advisors have followed decision tree type algorithms to advise their clients about asset allocation or these kinds of decisions. However, so that's kind of a weak AI solution to financial advice. However, if you resort to strong AI solutions, so that means trying to decipher what the customer needs but does not state. Because a consumer can say, look, okay, I'm interested in better financial returns, but I'm not particularly risk-taking. But another consumer may not state that, so you have to actually infer that from the way they're spending their money, by looking at their bank transactions, by looking at their behavioral fingerprints. So what I'm saying is that some financial consumers are savvier, or they're more aware of what their own financial personality is. Others are not, and just feeding them typical psychometric tests does not help. So you actually need to dig deeper into the way they conduct their finances. And with open banking, you can do that, right? So you can actually look into people's banking transactions. So AI could be very helpful in providing rich financial advice in situations where the consumer itself does not know what he or she wants, or maybe knows but is not able to articulate it properly. And I think that's where AI can complement, again, human advisors.
Okay.
If not replace them in this particular case, if not replace them. Yeah.
Yes. All right. So thank you very much, Professor Eshraghi, for your time. And so please join with me to thank Professor Eshraghi.
Thank you very much.